Happy Monday, everybody. Okay, so this week we've got a big announcement. Actually, not we, Zanetti. We, as in, we're expecting a big announcement from the Fed. The Fed meets on Wednesday, and they're going to announce whether or not they're going to keep rates the same, raise them, and lower them. And as you all are aware, most likely everybody thinks they're going to lower them. Now, the question is, are they going to lower by half a percentage point or just a quarter? Here's my guess. I'm guessing they're going to lower it by a quarter, but we'll see. The Fed is always sneaky. You know, they always give these hints of what they may do, and then they do something else. So we'll see. I'm not too concerned one way or another because that doesn't change our investment strategy. But it is interesting to note if they do lower it, this will be the first change that they've made in 14 months. It was actually July of 23 when they last raised the rates for the last time. And since then, we've had a high interest rate market, and that has put pressure on the economy. And the whole goal has been to lower inflation. Now, we'll see if the Fed thinks that they're on the right course for lowering inflation. We'll see. This is interesting, though. When you look back at the Fed going into rate lowering cycles, if you go back through history and look at what has been the outcome of that with the stock market, typically the stock market goes on to have declines. And it's not necessarily because the Fed is lowering rates, it's because of the environment in which the Fed is lowering rates. So the Fed's not lowering rates because they think everything's great. They would be lowering rates because they're concerned about the economy, specifically recession. So if we're going into a recession and therefore the Fed lowers rates to combat that, it's the recession that has an impact on the stock market. So, all right, so speaking of the stock market, let's look at current valuations. Right now, Greg and I talk about how we all know it's at record highs. And one of the valuations we look at is called the Buffett indicator, when you look at the stock market compared to GDP. Well, and I've talked about that in prior videos. Well, today I'm going to talk about another ratio. It's similar to the PE ratio, price to earnings ratio. Everybody's familiar with that. Well, there's another ratio similar to that, and that it takes into account inflation. That's called the Schiller PE ratio. In business school, we called it the CAPE ratio. So the average since 1871, the average of that ratio has been just below 20%. Right now, it's at 35. And there's only been two other times in history since 1871 when it was above today's score. That was during the dot-com bubble when it was at a 44, and then in 2022 when it was at 40. Now, both of those bubble pops that happened after those high CAPE ratios were severe. The stock market fell dramatically. 2022, it fell 24%. Now, that fall was arrested. It was slowed down because the federal government dumped $6 trillion in the economy, and the stock market went back up to where it's at today. So that 2022 stock market correction was short-lived, but it did happen. Here's the bigger picture. Since 1871, there have been six instances, including ours today, where the ratio was greater than 30. Now, the five previous have had major market corrections between 20 and 90%. And that's where we're at today. Now, this is the only instance where it hasn't yet corrected. So now the Schiller PE ratio is not a measurement of time. It's just a ratio on the value of the stock market, but it doesn't indicate when it's going to correct. In fact, it could go even higher. And it was higher in 22, and it was higher in the dot-com bubble. So it could go even higher. The point is, it's already in one of the top three highest ratios ever, and the Fed might be lowering interest rates now. So, and why is that? because they're concerned about a recession. And what does that do to the stock market? It corrects it. So all indicators are pointing to a big market correction. Question is time. Now let's look at what has not been correcting. That's gold, right? A lot of you are probably aware that gold recently closed above 2,500. It's around 2,575, 2,577 an ounce. That's a record. Now there's a hedge fund manager, very famous, one of the most famous hedge fund managers. His name is Naseem Taleb. He wrote a great book. You might be familiar with his book even more than his name. His book was called The Black Swan. And he talks about black swan events, those outliers that you just don't expect to happen that have major implications on the stock market. Well, he has played those black swans and been prepared for them and has done just very well. Well, Naseem was recently talking about the price of gold and how what that is really showing is a reflection of de-dollarization. Because when you think about it, it's not so much that gold has gone up in price, it's that it takes more US dollars to buy gold. So it's because, as we say, gold is what keeps up with inflation over time. And so it just takes a lot more dollars than it used to buy 1 ounce of gold. And that's because the dollar is dropping in value. And then you've seen central banks where they're slowing down on their stockpiles of US treasuries and instead stockpiling gold. So all of this is good news for you. And with that, y'all have a great week. Take care. Bye-bye.